Hi there. I hope you're keeping well. Welcome to the submodule on the ownership regime applicable to federally regulated insurers. Given the very important roles that insurers play in the financial services sector, it's a good idea to regulate who can be a significant owner of such institutions. The ownership regime, which focuses almost exclusively on share-based insurers, is comprised of two axes. First axis would be the ownership categories and the related rules that are based on the size of the insurer. Now you can imagine, the bigger the insurer, the more restrictions and scrutiny it'll have to face. The second axis is the requirement to obtain approval of the Minister of Finance before acquiring or increasing a significant interest in a class of shares of an insurer, including before acquiring control of an insurer. Let's begin by examining the first axis, which we will call the x-axis. Now, the x-axis comprises the categories and related rules based on the size of the insurer. It should be noted that the size of an insurer is measured by the value of its equity as reported on its balance sheet. And this first axis, in other words, the x-axis, it should be noted that it does not apply to mutual insurance companies or frats. So let's examine the x-axis in greater detail. And let's start actually with the first of the three categories of share-based insurance companies. Demutualized insurance companies with equity of $5 billion or more at the time of demutualization. The ownership regime requires these large companies to be widely held at all times and that no one acquires control in fact of them. A widely held insurer means that no one holds more than 20% of any class of voting shares and that no one holds more than 30% of any class of non-voting shares of that insurer. So what is the rationale for requiring that large demutualized insurers, such as Sun Life and Manulife, be widely held? Well, let's turn to an excerpt on page 33 of the 1999 policy paper. And I quote, "Consistent with the approach to bank ownership, the government believes that there is merit to continuing to have large mutual life insurers that are widely held after demutualization." End quote. Okay, so if this is a copy and paste of the rule applicable to large banks, what is the rationale for requiring that large banks be widely held? Well, for that, let's turn to an excerpt from page 16 of the 1999 policy paper. And I quote, "It is important that Canada's large banks be allowed to develop their strategic vision free of any unnecessary constraints and based on the best interests of depositors and shareholders. Allowing a single shareholder or shareholders acting in concert to control a large bank is inconsistent with this premise and could lead to situations where the bank's policies are slowly steered away from the best interests of the rest of the stakeholders." End quote. Before we move on to other categories, just remember that the large insurer category only applies to demutualized insurance companies with equity of $5 billion or more at the time of demutualization. At present, there are only two such insurers: Sun Life, and Manulife. Now, let's turn to the second of the three size-based categories. That is, insurers who have equity of $2 billion or more, but below $5 billion at the time of demutualization in the case of a demutualized insurance company. Although the widely held rule does not apply to such financial institutions because of their smaller size and role vis-a-vis large demutualized insurers, the ownership regime generally requires that 35% of the voting shares of these institutions be offered to the public by being traded on a Canadian stock exchange. I say generally because the ICA grants the Minister of Finance with the discretion to exempt an insurer from this requirement, which is often called the 35% float requirement. As for the rationale behind the 35% float requirement, I will quote an excerpt from page 32 of the 1999 policy paper. While the excerpt refers to banks, the reasoning applies equally to other federally regulated financial institutions. Quote, the 35% public float requirement ensures that any bank with equity over $2 billion is subject to disclosure requirements under securities laws in the interest of transparency. This enables the scrutiny of professional market analysts, rating agencies, and other stakeholders. End quote. Here's another excerpt from page 10 of the 1990 overview of legislative proposals regarding the 35% public float requirement, which was first introduced in the 1992 Insurance Companies Act. Quote, the 35% rule will ensure a significant public shareholding to provide a counterbalance to the influence of any majority shareholder. An element of broad public ownership can bring benefits in terms of ensuring market scrutiny and establishing the basis for sound corporate governance. End quote. Now let's turn to the third equity-based category, insurers with equity of less than $2 billion, also known as small insurers. Because of their even less important role relative to insurers in the two other categories that we just discussed, the regime gives owners full latitude in the choice of ownership structure over a small insurer. In other words, subject to the y-axis, which we will discuss soon, a shareholder may own all of the shares of a small insurer. Well, since small insurers can eventually see their equity reach the 2 billion threshold, the regime contains a related transition rule. Section 411 of the ICA states that within 3 years after the first annual meeting of shareholders following the time at which an insurer's equity reaches or surpasses 2 billion, the insurer must comply with the 35% public float requirement unless the minister has exempted it from the requirement. We've now completed our examination of the x-axis of the ownership regime. But before turning to the y-axis of the regime, let's go back briefly to mutual companies and frats. As I mentioned in the beginning of this submodule, these two types of entities are not subject to the size-based rules. And the reason for that actually makes good sense, because by the very nature of their corporate structure, mutual insurers and frats are widely held. In all cases, they are widely held. And since, as we discussed, the widely held rule is the most stringent of rules, and it applies to demutualized insurers with equity of $5 billion or more at the time of demutualization, Well, there is no need to contemplate other types of categories because the mutual companies and frats happen to be widely held and will always be widely held, and that's the category with the most stringent of rules from the size-based perspective. All right, so now let's turn to the y-axis, which is based on the same policy that underlies the approval of the Minister of Finance to form a new federally regulated insurer. That is, a fit and proper assessment of a prospective significant shareholder to help ensure that this prospective shareholder is not a source of weakness to the insurer. In almost all cases, the approval of the Minister of Finance is required before an individual or an entity can acquire or increase a significant interest in a class of shares of a federally regulated insurer, including acquiring control of such an insurer. This is the y-axis of the ownership regime. Sections 407 and 407.1 of the ICA require approval for the acquisition or increase of a significant interest in and the acquisition of control, in fact, of a federally regulated insurer. These requirements are common denominators for all federally regulated financial institutions, regardless of the value of their equity capital. Note, however, that obtaining a Section 407 or 407.1 approval does not override the X-axis rules applicable to non-small insurers, and that the ICA states that no one may acquire control, in fact, of a large demutualized insurer. So what is a significant interest in a class of shares? What does that mean? Well, Section 8 of the Insurance Companies Act states that a person has a significant interest in a class of shares of an insurer where that person and the entities controlled by that person together own more than 10% of all outstanding shares of that class. Arguably, Parliament is of the view that ownership of more than 10% of the shares of a class gives or may give the person unusual influence over and a close connection or relationship with the insurer. It can also be argued that the special position of such a shareholder justifies prior approval of the minister. Like the application to form a federally regulated insurer, the application for the minister's approval to acquire or increase a significant interest or to acquire control, in fact, of an insurer is filed with OSFI. In addition to the applicant's potential prudential implications for the insurer, the superintendent's recommendation to the minister relates to the factors that the minister must take into account under Section 420 of the ICA. These quote-unquote fitness and properness factors are the same as those set out in Section 27 of the ICA, which we discussed in the previous submodule. And these set out the factors that the minister must consider in deciding whether or not to approve the formation of federally regulated insurers. In addition, per the guidance note on support principle, where the applicant is proposing to acquire control of an insurer, the applicant is expected to provide a signed acknowledgement that they understand and that they accept the superintendent's expectation that they will provide any necessary ongoing financial, management, and operational support to the insurer. In accordance with Section 1016.1 of the ICA, the minister also takes into account national security and, where applicable, Canada's international relations and Canada's international legal obligations in connection with their decision to grant a Section 407 or 407.1 approval. All right, so to summarize, we have discussed the two main components or axes of the ownership regime. One, ownership categories and related rules based on the size of the insurer. Two, the requirement to obtain the minister's approval before acquiring or increasing a significant interest in a class of shares of an insurer, including before acquiring control of an insurer. With respect to the first axis, or X-axis, for demutualized insurance companies, there are three sizes: small, medium, and by medium, I'm referring here to insurance companies who have between $2 billion and $5 billion of equity at the time of demutualization, and the third category, which is large. And by large, I'm referring here to a company with equity of $5 billion or more at the time of demutualization. For all other share-based insurers, there are effectively two sizes: small. Again, those small institutions are the ones with equity of less than $2 billion, and other, if you will, which refers to insurers with equity of $2 billion or more. Subject to the second or Y-axis, small financial institutions are free from any ownership constraints because of their smaller size. All others, except for large demutualized insurers, must have at least 35% of their voting shares offered to the public and traded on a Canadian stock exchange, unless the Minister of Finance exempts them from this requirement. In the case of large demutualized insurers, they must be widely held and no one may acquire control of them. The second or Y-axis of the regime focuses on ownership-related approvals. In almost all cases, acquisitions of or increases in a significant interest in a class of shares of a federally regulated insurer, including the acquisition of control of such an insurer, are subject to the minister's approval. The applications for these approvals are filed with OSFI, and the ministers review the application following a recommendation by the superintendent. The process allows the superintendent and the minister to assess the fitness and properness, or otherwise known as the suitability, of the proposed significant owner based on the factors enumerated in Section 420 of the ICA. We are now at the end of the submodule. See you soon.